Hi, today I want to talk to you about the most important factor in your trading success, and that is risk management. Did you know that most traders don't even try to limit their losses? They trade without stops, they overtrade, and they don't have a trading plan. So this video will focus on these key issues and help you to put yourself into that minority of traders who actually know what they're doing and have a chance of success in this business. You know, I'm sure that every business needs risk control measures. If no risk controls are in place, it's almost guaranteed that costs are going to exceed the profits. And the same applies to your trading business. Without the right risk management measures, you are kind of like a football team without any defense. You might get lucky once or twice and win a game or two, but your chances of a long-term success are very close to zero. Remember this: offense wins games, defense wins championships. So if you want to be successful and long-term winner in this trading business, you really need to take this video seriously and study its contents over and over again. So let's dive in. First of all, please do remember that we don't provide any investment advice, and all the material is made available for educational and marketing purposes only. And please remember to subscribe to the channel. That would be a great help. Thank you. Okay, let's talk about why risk management is needed. Now, risk controls are needed so that the risk remains constant and isn't random. It's totally impossible to manage something that is random, something that's all over the place all the time. So we want to have a plan, a trading plan that focuses on keeping the risk constant, and everything else works from this perspective. Once we have a trading system that has a constant risk, then we know what to do with leverage, then we know what to do with risk taking and how we can improve timing, etc., etc. So that's highly important. Then, secondly, we want a high reward to risk ratio. This means that in the long run, you stay in the game. And thirdly, winning trades need to produce more than you lose when the trades don't work out. So all of these points, they kind of underline the fact that you need to have a long-term positive expectancy, and this is what we aim for. Next, I want to show you with a couple of graphs what it means if the losses are random versus if they are contained to, say, a maximum of 2%. This is a simplified example where I'm assuming there are, X number of trades, and here I have, just 100 losses, and there is no risk controls in place. The risks are random. I created this with Excel, and you can just look at this picture and realize that most of the time the losses are just about 50%. Actually, the exact average is minus 49.92%. And 19 times out of 100, the losses exceeded 75%. So it's very difficult to recover if you lose 50% of your account. If you lose 75% of your account, it's basically game over, because you would need to make so much more in order to actually come back to the break even again. Here in this chart, you can see how much you have to make if you have lost X percentage of your account. So if you've lost 70%, you need to make 233% just to get back to break even. So you really want to think through whether this is something that you are going to survive, both psychologically and in terms of your trading capital. Here I have another sample of 100 trades or 100 losses. They are also random, but they are limited to 2%. And here the average loss is minus 0.44%. When you limit the losses but allow the profits grow, your strategy can have an edge. It can have such a good edge that you will have a long-term positive expectancy, meaning that after all the losses, your system makes money. Actually, to be exact, after all the losses and the trading expenses, you are still a profitable trader. Okay, now that we understand why risk management is so very important, I want to give you some practical tips how you can go about managing the risks in your trading. So, first of all, when we are looking for trades, we very often look for uptrends or downtrends, and we want to be buyers at support levels when the market is trending higher. We want to be sellers at resistance levels when the markets are trending lower. And this also is part of your risk management. You want to manage the market risk by timing the market. So let's study a couple of examples, and then I'm going to talk to you about budgeting your trades and something else too. Okay, here's an example. This is S&P 500 in 10-minute time frame. It's an example of managing the risks, the market risk with timing. It's basically referring to what I was talking about earlier. And what you do when you see a clearly trending market with higher highs and higher lows, you look for opportunities to buy at supports. There's a support level, and when the market comes back to it, there's a nice swing from it. Then another opportunity over here. The market comes to the level, finds support, and then the same level is support again. But now, this is a good reminder that nothing works 100% of the time, and that's why we need to have risk management in place. This penetration could have turned into a move to the downside, and you definitely don't want to be involved in a market that is trending lower. So you might want to have a stop that takes you out here, or alternatively have a smaller position size and then place your stop further away from the market. Then if we move on, let's see that the market created another higher low and then a support here. It basically retraced back to a level that used to be a resistance, and then a little bit later on the market came back to the same level, almost touched it, but then started to move higher. So again, you might want to consider a strategy that starts to buy slightly above a support level, or lots of professional traders, they scale into their positions, so that's really there's really nothing wrong in buying your whole position in 2 or 3 different portions. Then let's look at a downtrend quickly. Here we have the market making lower lows and lower highs, and you have 2 types of resistances. There's one that's created here where the market finds support, then penetrates the support, and the trading opportunity comes when the market retraces back to the level. Another type of resistance is here where you have market creating the resistance and then market comes back to the level and reacts from it. So there's another opportunity to join this down move. And this is one way, as you can clearly see, of managing the market risk by timing the market. But sometimes things don't work out. We read the market wrong, or there comes something external into the market. A new news items hit the market and make it move differently than we expected. There we need to have stops in place. We need to budget something for each trade. We just can't go and say, okay, I'm going to say that this whatever it takes, I'm going to stay with this trade. That's the way to lose money. That's the way to lose accounts. That's the way to really give your money away. So next, I want to talk to you about budgeting, having a weekly, daily, and per trade budgets. In your trading plan, you need to define beforehand how much risk you're going to have per week, per day, and then per trade. If you start at the weekly level, say for instance that your maximum risk per week is 10%. And that's basically assuming that everything you do goes wrong during that week and you end up the week just 10% lower with your capital. And I'm talking about the risk capital, not your personal wealth. We're not talking about the net worth of you. We're talking about the money that you have set aside as risk capital that you can trade with without it impacting your emotions or financial standing in any way. So let's say your weekly level is 10%, that breaks down to 2% per day. And if you take, for instance, 4 trades per day, then you're risking 0.5% per trade. And I would suggest that you do this, and obviously you can change the numbers, you can go for lower numbers if you feel it necessary. All your decisions in risk taking should be driven by your trading statistics. The more money you make, the more risk you can take per trade, and the higher success level you have in terms of reward to risk and the successful trades as a ratio compared to losing trades, the more risk you can take. But if you're not yet, if you're still struggling with trading, then I suggest you might go even to lower numbers, maybe just accepting risk in terms of, let's say, 0.2% per trade. Then once you know this, you can do this for 30 trades, for instance, and then evaluate your results. If you're happy with the results, then you can increase the risk and go up to, say, 0.75% per trade for the next 30 trades. Then you evaluate again. If you're happy with the results, you go to 1% per trade. And by doing this, you keep your emotions in check and you make sure that your emotions are not hindering your performance and your growth in your trading business. And finally, I want to remind you of these 3 important questions that you have to answer before you open any trades. Where do you exit with a loss? So if the market moves against you, say you get a trading signal there to go short, but if the market doesn't move in your favor and starts to rally, where do you exit? That has to be very clear in your mind before you actually open the trade. So I very much recommend you place a stop in the market so that you're automatically out of the market if the market moves too much against you. Then secondly, where do you exit with profit? You can either have a profit target in, say, with a short trade, you might want to place it at a support level, or you might want to just follow the market and see if it stays below a moving average and keeps on trending lower. You stay with the trade, and if the trend reverses and the market starts to rally, then you exit. So these are a couple of options that you can consider. And then finally, number 3, do you close your trades for the weekends? Do you close your trades at the end of the day? This is highly important because especially during the weekends when the markets are closed or during market holidays, there is an increased risk of gaps. So the market might gap higher or lower. It might work against you or for you. We really don't know beforehand. And when we don't know, there is no edge, and that we should not. This means that we shouldn't be in the market. So these 3 questions you have to answer before you actually take any trades. I personally like to close all the trades before the weekend so that there is no chance of market gapping up or down and stopping me out at unfavorable levels. Okay guys, this was all from me today. If you like the content, give me a thumbs up and also subscribe to the channel, and I'll see you on the next video.